Beta is a key concept in finance that measures the volatility of an investment, such as a stock, in relation to the overall market. Think of it as a way to quantify a stock's sensitivity to market swings. The overall market is always assigned a beta of 1.0. This market is typically represented by a broad index, like the S&P 500, which serves as the benchmark against which individual stocks are measured. A stock's beta tells you how much its price is expected to move for every 1-point move in the market. Beta of 1.0. A stock with a beta of 1.0 moves in line with the market. If the S&P 500 goes up by 1%, this stock is expected to go up by 1%. If the S&P 500 falls by 2%, the stock is also expected to fall by 2%. Beta less than 1.0. A stock with a beta less than 1.0 is less volatile than the market. For example, a stock with a beta of 0.5 would be expected to go up by 0.5% when the market rises by 1%, and fall by only 1% when the market falls by 2%. These are often considered defensive stocks, like those in the utility or consumer staples sectors, as they provide more stability during market downturns. Beta greater than 1.0. A stock with a beta greater than 1.0 is more volatile than the market. For instance, a stock with a beta of 1.5 would be expected to rise by 1.5% when the market rises by 1%, but also fall by 3% when the market falls by 2%. This higher volatility signifies greater risk, but also the potential for greater returns. What is a high beta stock? A high beta stock is any stock with a beta value greater than 1. These stocks are known for their price swings being more dramatic and frequent than the general market. High beta stocks are often associated with companies in high-growth industries like technology, biotech, or emerging markets. These firms are typically seen as having significant growth potential, but their unproven business models or competitive pressures make them more susceptible to market sentiment and economic changes. The significance of high beta stocks lies in the classic risk-reward trade-off. For investors with a higher risk tolerance, these stocks are attractive because they offer the potential for accelerated gains during a bull market. When the market is on an uptrend, high beta stocks can significantly outperform the broader indexes, delivering substantial returns. However, the reverse is also true. In a down market, high beta stocks can experience sharper and more pronounced losses. This makes them particularly risky during bear markets or periods of economic uncertainty.